Good afternoon and welcome to the BEEKS Financial Cloud Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time just by using the Q&A tab situated in the right corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Gordon MacArthur, CEO. Good afternoon to you, sir.
Hi, thank you, and welcome, folks. I'm going to, as usual, if you've listened to do this before, I'm going to do the first few slides and overview, and then I'll hand over to Fraser, who's going to go into more of the financials, and then we've got Q&A at the end. So, who are BEEKS? It's always difficult in this because we don't know if, who's attending and who's not. So, BEEKS Financial Cloud, our cloud computing company based up in Glasgow that solely cater for capital markets, right? So we do cloud computing and we focus on the data centers that trading activities take place in. They tend to be specific financial services data centers, whether that be owned by an exchange or owned by a third party. And we deploy our infrastructure in there and connect to various endpoints within the data center. And then we tie all that up. We tie all these data centers up together with a backbone that runs around the world. So just kind of going to cover some of the highlights from the first half of the year. So proximity and exchange cloud is what we're going to spend most of our time talking about today. The percentage of revenue and the two new offerings that we see as the kind of future of the company has doubled from 10% to 20% of the first half revenue year on year. So kind of as expected, and we hope that will continue to grow. We've got a substantial proximity cloud and exchange cloud pipeline. And we're now starting to see material contributions from the two new product lines, which is good. As we announced on Monday, we have won our first exchange cloud contract with a partner in the crypto space. So previously, everything we've done is equities asset class specific, and we'll continue to focus there. But we've signed a deal with Kraken, one of the larger crypto exchanges, one of the more sophisticated institutional flow type exchanges, for them to license Exchange Cloud in the European data center. And we've done that under our new revenue model, which will take some time to explain today. We've been looking at this revenue model, or kind of revenue share type agreements for the last 12 months, and we have decided to move forward with it. Not to say that we're ditching or halting the old model where it was a long-term contract at X amount per cabinet per month. It just means we have two commercial models that we will use in differing situations depending what is fit for both the client and BEEKS going forward. So not walking away from the old model, but we are introducing this new revenue share model, which ultimately will be more profitable for the organization, and we'll continue to cover that as we go through. But, it materially shortens the sales cycle, so we are not asking customers to budget millions and millions of dollars, which usually tends to go into the next budgeting cycle. The revenue share agreement means that we are going into it with a pretty much zero commitment from the client, and we are willing to take the commercial risk on that upfront in certain situations. Operating cash flow was up 21% year on year, so we've delivered more profit, more cash than we have in previous years, which is obviously good. And as I say, Fraser will cover more in-depth financials as we go through. So this slide hasn't really changed that much in the last few years. We've got a new, for anyone that's been following us for any period of time, you'll see there's a new edge intelligence section in here, which we'll cover. But 90% of our revenue is still trading infrastructure, compute, network within the data center, virtual machines, and that will continue, right? That's been the heart of the business. We are an infrastructure service company, and that's what we do. We also have, as I said at the top, a low latency wide area network. We don't run cables ourselves, obviously, under the sea. We buy routes from. Sorry, we're in a hotel. We buy routes from various cable carriers around the world and patch that together depending on our requirements. And we've got a small professional services division where we make a couple of percent of revenue. The new part of this is a new product we're building called Edge Intelligence. It's kind of related to an analytics offering where we capture as part of our analytics, and it doesn't have to run on BEEKS analytics. It can run on other analytics packages out there. Banks and brokers and exchanges generate and capture huge, volumes of data, and it's market data, right? So it's very low level, fixed messages, very, text files that are, NYSE's got the biggest feed in the world. Opera can pump out 100 gigabytes of data per second in this very low level fixed messaging language. And it's got a lot of value in it, but it's very difficult to do anything with it because of the size of it. And we capture that, and various other analytics offerings out there capture that data. So what Edge Intelligence is going to do, and the first use case for it, we've been building it for about a year, is to look at anomaly detection. So it's more of a machine learning environment at the moment, where we've trained some machine learning models to look at years and years worth of data to understand what is normal. Right? When you understand what is normal, you can very quickly identify what is abnormal, what's an anomaly. And anomalies might last for, a millisecond. They might last for a second. And they all have some data attached to them. But manually sifting through all that data to try and find them is impossible, right? So our Edge Intelligence platform will, in real time, alert a bank, a broker, HFT, an exchange, that there is an anomaly somewhere in the system, and we're scoring that at the moment between 0 and 100. The higher you get towards 100, the more serious the anomaly is. So what that will do is alert in real time that there's something strange going on in your environment. At the moment, we're not telling you what, but what we will do is attach a link to the packet capture and that specific piece of data that is suggesting there is something going wrong in your overall trading infrastructure. So trade operations people can do a deep dive into it. And then there's a lot more use cases as we go along. So we've been building that for a year, still about 6 months from being ready, but we're working with a couple of large organizations to guide our kind of strategy there and a product roadmap, and a lot of technical challenges still to be overcome. Can we do it at the scale that's needed? Still to be answered. And can we ensure the accuracy at scale? So that's going to be the next 6 or 7 months of work until we get it into version 1 of a product. But this is how we build products historically. Exchange Proximity Cloud is, we have an idea, we go and talk to our clients about it. If they verify it's useful, then we work with them to try and productize it. And Edge Intelligence will be no different to the journey that we did with Proximity and Exchange. So the 3 parts of the business: private cloud, still a big part of the business, still continues to grow every month. And these are, smaller, sometimes month to month, sometimes annual deals, sometimes 24-month deals, where a client will buy a level of compute from us, some shared networking, sometimes it's completely dedicated networking. We basically build a bespoke private cloud for a client. And it can be anywhere between 1 to 20K a month type deals. We've got some very large clients in there. And that has always been the majority of our revenue, since we IPO'd. As Prox and Exchange build, we expect that they will take over as the main drivers of percentage revenue for the group. Proximity Cloud, was our first foray into a dedicated cabinet that we deliver to clients. Single-use platform for use for a bank, broker, investment manager, whoever wants it. They will use it to run their internal workloads. And we've had some success in that. We've signed our biggest deal ever last year around Proximity Cloud for a large bank that is currently rolling out. And pipeline for that is continues to grow. So single-use platform, rack-based end-to-end trading infrastructure. Exchange Cloud is very similar to Proximity Cloud. The only difference is it's multi-homed. So multiple clients can exist securely in the same rack. So we can effectively break up the infrastructure in that cabinet and assign it to multiple clients. And nobody can see or be affected by the other clients' trading activities. Proximity Cloud kind of 1 to 5 million, can be bigger. Exchange Cloud over the period, Exchange Cloud is very much a land and expand type of contract, right? And I think we're going to go on to JSE again in the next slide. So, it is materially bigger as we go through the contract. As we usually start off with a couple of cabinets, and then that can grow materially. Just a quick overview of some of the figures. So all point in the right direction. Again, historically we've always grown between 20 and 30%. Kind of year on year, this was kind of in line. From a revenue point of view, EBITDA up 25% and PBT up 37%. Positive net cash again, and 75 to 76% of our earnings are on a monthly recurring basis. So, it's not a best quarter, not a best half ever. Sorry, not by no means a worse. Very solid performance for the business. This shows our Exchange Cloud footprint, right? As it continues to grow. And we hope to colour in more of this map over the next year to 2 years. So we started with JSE. ICE were actually the very first ones to license it in the ICE Global Networks division. Then JSE were the first to put it in their core data centre. The Tier 1 exchange, we have made announcements that was NASDAQ. And I'm sure there's going to be a lot of questions here, but we're still under NDA. I'm not going to be able to talk much about it. It is proceeding as planned, but we're still under NDA, so limited in what we can say. Mexico is actually the largest Exchange Cloud deal to date. Signed in February. They are going for production and DR in the primary and secondary data centers, and that will that's kind of rolling out at the moment. We are building that in Glasgow and shipping it out over to Mexico in the next few weeks to get that live and before the end of the financial period. And emerging markets is just to finish this. So Kraken first foray into crypto. Very short sales cycle on the revenue shared deal model. So it's usage based, and I think we've got more slides to cover as we go through that. So for the last 12 months, I've been talking much more about emerging markets. Emerging markets, are where we are focusing our attention with Exchange Cloud. It might be kind of opposite to where people would naturally assume, but some of the emerging markets are operationally difficult for Western companies to operate in and to trade in. Some of the biggest growth rates in exchanges, in fact, all of the biggest growth rates, percentage-wise, volume-wise, in exchanges are in emerging markets. So there's a lot of companies want to trade in India and Saudi Arabia and Mexico and Malaysia and Philippines, but they don't have entities there. They don't have import licenses. They don't have staff there. So there's a pipeline of demand. There's operational difficulty, and that is where we actually see the biggest opportunity. I think last year when we talked about this, I thought it was about parity between developed and emerging. The more we've gone into this year, and with the pipeline that we've got, the emerging markets are probably going to be the dominant source of revenue for BEEKS going forward, which, as I say, is probably opposite to what you would think, but there's growth potential there. You know, a lot of the developed exchanges have got a lot of the market participants in, and we'll pick up, as we sell into the developed markets, we will pick up business and hardware refreshes and growth and new participants, but there's a backlog of demand for emerging markets. There's certain exchanges that I could probably fill 10 or 15 cabs in immediately if we can get Exchange Cloud launched in emerging markets, and that's material source of revenue for us. So, you know, look as we go forward, look for us to make more announcements in and around the emerging markets as well as the developed ones. But that's the current map, and as I say, by this time next year, we hopefully present it, and there's a lot more blue in there. This is the GSC slide that I think we presented last year, but it's a really powerful slide, and it's worth going over again. So GSC are, you know, I think 28th largest exchange in the world, largest in Africa by a long way. We signed them a couple of years ago, and we thought overall the contract may be worth, you know, 2 to 5 million at a push over the total contract period. We've underestimated that substantially, right? And you know, GSE have extended a number of times and will continue to do that. Pipeline's still significant with new people wanting capacity, and they're getting towards, you know, the limits of their existing capacity. So we fully expect GSE to continue to extend. We're putting in a DR data center at the moment. That is a secondary data center. Banks cannot just have primary. They need a failover if there is an issue in the primary data center. So that gives us a second site to work with. So, you know, as we get more mature with GSC, and I spend a lot of time down there with the clients, with the exchange themselves, we fully expect GSC to spend between 15 and 20 million once we get into the kind of fourth and fifth year of that contract. So that shows you the land and expand opportunity without doing the GSC a disservice. You know, one of the smaller exchanges globally, it shows you what the potential is for some of the developed markets and some of these emerging markets in terms of revenue over the contract period. And we fully expect after the initial contract period with GSE, they will extend. You know, we look at these as 15 to 20 year kind of deployments. The new revenue share model. So we've been thinking about this for the last year. And I think what finally pushed it over the line for us was Mexico. So Mexican exchange was about a year and a bit of, you know, maybe just under 2 years of sales cycle. A large part of that sales cycle was waiting for them to get budget unlocked. So they had decided they're going to go forward with the platform. They built a business case. It had been approved by the project team. Then they have to make a submission into next year's budget cycle to get the money to sign the contract with us, right? So, you know, their budgeting cycle was, you know, January to December. If we'd taken that away and, you know, the revenue share model had been there, we would have been live in Mexico, and we probably would have been extending the contract already. So we've had a material delay because of budget constraints of the exchange. Mexico is a big deal, right? It's one of our biggest deals we've ever done. So it's not an insignificant spend for them. So it was done in a classic model, and we charged 20k a month or 25, depending on what it is, 20 to 25k per month per cabinet over multiple years. And that's what you commit to. That's what they sign. The new model, and our phrase will talk about the revenue rec on it as well. The new model, we're not throwing away the old model. The new model is we sign a rolling 30-day contract, no long-term commitment, don't pay us anything on day one, but we will take a percentage split of that revenue, 50-50, whatever it is. Not going to make it available to everyone. And in certain situations, without going into stuff that's potentially sensitive, if the exchange commit to certain activities with us, we will allow that revenue share model. So over the period of the contract, we will make more money, because when a cabinet's full, we're probably getting about a third of the revenue at the moment on a full contract, whereas we will get half or there or thereabouts when a cabinet is full under the revenue share model. So just to it's very long-winded, very nuanced, right? But brings in sales cycles. No need for budget approval. No need for executive steering group approval. No need for board approval. Materially easier for an exchange to commit to. Materially more profitable over the term of the contract for us. There is a lag until that they are full. The cabinets are full, but once they're full, it makes us more money. We have got a level of commercial risk, but again, without going into stuff that might be commercially sensitive, we can lift and shift that environment if it's not performing, right? If there's no demand there. So it's not like we deploy the infrastructure and it's written off. We can move it to another data center or another location if we wanted to. I don't know if you want to touch about the different revenue records.
Yeah, sure. Good afternoon, everybody. I think so. The revenue, the accounting is very different under the two different models. As Gordon says, we're doing this for commercial reasons, but it does have a difference in the accounting. So on the traditional model, we take about half of the contract value upfront on day one. Okay, so if you looked at results over the last couple of years, you'll see we've got point in time, we've got point over time. Right now, going back before Proximity and Exchange Cloud, we always had this nice recurring revenue profile, which was smooth and always kind of going upwards. So, the revenue share model, what that does is it pushes it back into monthly recurring, right? So, and it's really because, two things. One is there's no contract value in day one. So in day one, we will get potentially zero, right? Whereas before there's an actual contract value. So the accounting is very different. So we've had to reflect that in some of the forecasts, because we've always assumed historically there's this upfront element. However, we're doing it for the right reasons, and commercially it's better, as Gordon said. So the cost is exactly the same. So this is purely accounting. And if you take the fact that we've assumed in this slide here that it will potentially take a year to get to full capacity. If it does that, we get about a third more revenue overall, but straight to profit, because the cost is exactly the same. So as we deliver more of these, we'll become a bit more au fait with how we forecast it. Will it take 3 months, 6 months, 9 months, 12 months to get to full capacity? We don't know yet, but we will get better at predicting that as we deliver more.
Thank you. So again, we're kind of showing we're investing in the sales team, with a significant investment in the sales team, and we'll continue to hire to tackle these emerging market areas. So Adam Bradley, who joined as head of APAC, we invested in some London resource. Swad, who's kind of head of pre-sales over in New York to support Jerry. So the sales team is the direct sales team that are targeting exchanges and banks and brokers has grown substantially. It's a very nuanced and involved sale. So we're very picky about who we employ in that sales team, because you have to have domain knowledge, you have to write contacts, you have to be able to understand and articulate at various parts of exchanges and banks or value propositions. So, we hire what we believe are the right people in the right areas. I kind of pre-jumped this edge intelligence slide. So, that kind of goes in, as I said, the first thing we're looking at is anomaly detection, but we've got a bunch of use cases as we add on AI modeling and AI forecasting into the core middleware that we've already built. We've got a number of customers working with us, as we did in Proximity and Exchange Cloud, to shape the requirements, right? And we kind of tend to give the if they then want to buy, they kind of get a bit of a sweetheart deal as being as a development partner. But we try and target the bigger ones, right? That we can capture. If you can do the monster accounts, then especially this, because a lot of the problems here is scale. If you can capture and model the bigger accounts, then the smaller ones become easy. So kind of launching next year, we have invested in it. So we have started to articulate it out to the market, and hopefully by the end of the calendar year, we are starting to see some signs of revenue flowing in the edge intelligence world, which gives us another revenue stream to go after. We'll hand over to Fraser to talk more in detail about financials.
Okay, thanks, Gordon. So, as Gordon says, we've had a decent set of results in terms of sales growth, right? So, looking back since IPO and over the last 5 years, we're typically around the 25 to 30%. So, we're maybe slightly at the lower end of that in this half, but still relatively consistent. And a big driver of that, as Gordon mentioned at the start, was proximity cloud growth in the period, right? So that was around, between proximity exchange, about 20% of the overall revenue. And as we look forward, we expect that trend to continue upwards. The deal sizes are, as Gordon says, the large UK bank that was delivered in the period influenced that growth, but the size of the deals in those products are a lot higher, and they're driving the growth there. Slightly lower in terms of the ACMR, so that stands for annualized committed monthly recurring revenue. So not quite as a bit more modest in terms of the growth there, 7%, which is historically quite low. We did flag in the results that we had some higher churn in our legacy business, historic part of the business. It's about less than 10% of the overall business. Again, and the reason for that, we changed software provider for very good commercial reasons. And as part of that project, a lot of these legacy clients took it upon that situation to clear out some of their historic estate. So bit of a one-off, not expected to recur, and didn't impact overall profitability because of that. Better software license charge that we've now got going forward. So that's in terms of recurring revenue. So again, pleasing to see that the profit is going in the right direction. So as Gordon says, we've had 25% growth in EBITDA, 37% growth in profit, and improved profit margins again. Now that's in spite of some of that churn, and also the market edge intelligence that we're investing in during the period we're expensing. So we're able to grow margins 1% or 2% while still investing. So the profit's going in the right direction. Staff is largely unchanged. We changed the headcount slightly. We've invested in sales, as Gordon says, but we also looked at some of the software development team, and that's had some natural attrition as we've had a new head of software who's streamlined some of the processes in there, so we've got a bit more efficiency out of that, which is good. And we're also capitalising a bit less of that as well, because we've now got established products. So again, profit margin is still improving with those going on as well. So and as we look forward, particularly around Exchange Cloud, and in terms of the different model, we believe that there's quite a bit in terms of leverage that you can still get. And if you look at the forecast, we're forecasting higher profitability, and we're comfortable based on what we know that's going to transpire. Again, profit's one thing, cash another. So over the last 18 months, we have started generating cash. So cash is going in the right direction as well. Operating cash flow is up over 20% to 5.8 million. The reduction in the net receivable payables, there's kind of two main drivers for that. Part of that is the upfront element of Proximity Cloud, where we take the revenue up front, but we collect the cash over time. So, there's a big accrued income increase, but that will start unwinding over the next number of years. So, flipping back the other way. And then I think, we mentioned in the results, we unfortunately got a delayed post-year-end payment of just over 1.2 million early January. So, not ideal, but nothing untoward on that other than, internal process and it was paid early January. So in reality, our cash should have been, at least 1.2 million higher at the end of the period. We continue to invest. So PP&E, so that's infrastructure. So that's the cost of our, putting the infrastructure out into the data centres. We utilised a bit of our existing inventory. So the 1.2 million, excluding stock, which reduced by about $1 million. So we'll always have that cost in our cash to put that infrastructure out there. And then the intangible assets is the cost of our development team. We've repaid some debt in the period. So, the balance sheet is in as good a position as it's ever been since IPO. We're generating cash, we have money in the bank, and we have low levels of debt. And, we expect that trend to continue. Okay.
All right, back to me. So, as I said at the top of the call, we kind of maintained our 20 to 30% top line growth. The business is 13 years old. It has grown every single half year since it's existed. So, I think we've got a good track record of delivery. Now, we've been in public domain for 7 years, I think. So again, we fell within our kind of expected area of growth. The business is, as Fraser said, the big thing was getting to cash generative, cash positive. We are there now. We expect that to continue to increase. Gives us the ability to invest where we want. We don't have to, unlike some of our old school MSP competitors, we're not using all of our free cash to pay our private equity owners interest payments. So we are available. We can invest and innovate within the business, and I think we're building up a track record of being a company known for innovation in the space. There isn't a lot of it, but that's where we'll focus and continue to innovate going forward. We're not a big M&A player. People have followed us for a while. We do look at stuff occasionally. We may or not do something small. I don't think we're looking for big material M&A opportunities. There's more bolt-on feature function where we would struggle to build ourselves because there's only so much we can do. So being cash generative helps that as well. We got a lot, with the exchanges, when we sign an exchange, their sales team are effectively selling our services. We've got very strong relationships with IPC, our biggest partner. We do a lot with them in terms of joint bids. We're a customer of theirs, they're a customer of ours, so we've got a good partnership. And we really are, the market's coming to us, right? I think proving that we have deployed this infrastructure now, it works, it adds value to exchanges and banks and brokers, whether it be proximity or exchange. We built the product, we innovated, we come up with the idea, but the market is certainly coming to us. So we're in a good position. The business is financially strong, and we've got a track record of delivery, which is worth its weight in gold. So going forward, what are we focusing on? Apart from revenue recognition discussions, which is not really something we want to continue having ever again. The current year is convert the proxy exchange like pipeline. It's substantial. We've got more equity exchanges in the final rounds of negotiations. Continue to invest in edge intelligence to get that ready, and continue to innovate. Right, as I say, we have a substantial software team. We have ideas within the business of other features, products we want to develop, and continue to automate rather than throwing people at problems. We need to automate systems more, and we've been doing that. I was telling another institutional investor this morning before I come down, some of the senior tech team were showing me a diagram of, how long does it take for the network team to build out a proximity cloud? Because or Exchange Cloud, doesn't matter, as we have to deploy more, we need to get better and faster at doing them. And the first few we did took us 250 man hours to build that network. The last one we did took 25. So that is us automating and innovating around the technology map that we've got. So by doing that, not having to continually employ people, that will drive that operational leverage and drive the bottom line. Last slide, and then we're going to Q&A. We're in the right place, right? The market is coming to us in terms of cloud computing and exchanges and banks. As we've been saying for the last 2 years, Exchange Cloud is our main driver. As edge intelligence comes on, does it become as big an opportunity? We don't know yet. We genuinely don't know. But the initial conversations we're having are very, very promising. But like any new product, as you build it, you don't know until you get customers signing check. Kraken is a great win for us. First in revenue share, and it'll really be interesting to see. It's really unknown for us because it is crypto and it is the first revenue share deal we've done. So we'll try and keep the market updated. I know there's a lot of nervousness after the change in revenue recognition model and what's happened with the numbers, looking out into the next 12 months. That will wash out as the revenue share deals start to become more profitable with uptake. So we will try and keep the market updated of how these revenue shares deals are progressing. Pipeline, as I say, is strong for Exchange Cloud, and we hope to make more announcements. When I say short term in Exchange land is not days or weeks, right? So, but we are various stages of pipeline from final MSA clauses to doing the initial business case to submit to the steering groups and what have you of various exchanges. So very strong. And yeah, we're excited, right? Our job as the directors of the company is to look at the long-term health of the business. Like, what's the right thing to do in the long term? Forget the noise that surrounds any short-term change. I know the market does not like change. However, we're in a better position than we've ever been, right? The opportunity is bigger than it's ever been. We continue to grow our total addressable market. I can't quantify that before anyone asks. I never can, because no one covers our niche market. So the business is in a great position. The team is stronger than it's ever been. A couple of really exciting senior technical hires that we'll announce in the next few weeks. Continued investment in the sales team to drive the new products that we'll develop. So it was an okay period in the first half, and we need to get head down, deliver the second half, and continue to win more business. So I think that is us. So thanks for listening, folks. I will go and look at Q&A. And apologies, there might be some questions in here that I cannot answer, so bear with me. All right, first question. Has there been any changes in the amount of exchanges around the world making inquiries since you announced your contracts? Yes. We are now getting incoming, right? Which we never got before. I'm not going to go into it because it's commercially sensitive, right? And I'm sure our competitors always listen to these calls anyway, so I'm careful what I say. But we are getting inbound from some of the most interesting exchanges in the world. So yeah, the more and more we exchange, the more and more we sign, the more pervasive and easy it comes to sign other ones. And it's linked to the second one. Is there any sign of due diligence speeding up? Yeah, one of the exchanges that we're hoping to announce next told us, they were not doing light touch due diligence, but because of some of the previous announcements that we've made, they are making certain assumptions that some of the bits and pieces they might look at and spend time at have been done. So yeah,
I'll pick next one up. So once a customer buys the BEEKS Exchange Cloud system, is there any follow-up revenue in following years, not including expanding the system? I.e., is there an ongoing rental payment or service fee? So I think on that one, so ultimately you have the difference. The revenue recognition doesn't always equal cash, right? So on the traditional model, you have this half up front and then the remaining contract value spread over the contract term, right? But that's purely revenue. That doesn't necessarily mean cash. So most Exchange Cloud proximity clouds are on a monthly recurring basis, right? So this change is really only in revenue as opposed to cash. Again, someone please explain the financial impact of the change to a revenue sharing model for Exchange. So I think that was a pre-submitted. I think we probably answered that. So I think,
yeah. There are suggestions that your offering might not be unique. Can you give the name of direct competitor in the niche market? I mean, where's the suggestions? I don't. It is unique. I'm sure our competitors are looking at building similar stuff, but track record means everything, right? So yeah. I think where you give an explanation for delayed payments eventually received, it's a big existing client who's been with us for many years. They just missed a payment run. You take that, Fraser, please.
Yep. So regarding the move to shared revenue, retaining hardware ownership model, over what sort of period will the hardware cost be depreciated? So we depreciate our hardware over 5 years, which is appropriate. Particularly proximity Exchange clouds, and they would get replaced, but there would be no change to that. And then, what are the risks now associated with owning that hardware in terms of obsolescence? Again, historically we've always done that, and infrastructure changes, but we're not seeing a risk in obsolescence on that type of hardware.
Will the new revenue model apply to existing customers? No. And there is no swapping between the two. When the customer picks which model they want, and both might never be offered, then you're on it forever, right? You can't have a client who says, we'll do revenue share until we prove it and it fills up, and then you take less. So absolutely not. I mean, I wish we'd done JSC and revenue share. They're delighted we didn't.
Does new revenue model mean higher cash outflow for BEEKS initially? No, not necessarily. So just now, so the cost for us is the same. So the cost of that hardware, it then becomes dependent on how quickly that rack fills up in terms of what the payback period is just now. So we are going from a fixed fee to a variable fee. So at this point, the honest answer is we don't know, right? If it takes 6 months to fill the rack, it will pay back quicker. If it takes 15 months to fill the rack, it will pay back a bit longer. So we don't quite know. It's a bit of an unknown just now.
Well, BEEKS have to fund capex when you deal with under revenue share model, and when you need to raise additional funds. No, there is no difference, right? The old model is 20k a month. We buy it all up front. We still buy it all up front. We just charge 50% or whatever the percentage need is, as and when that revenue comes in. We are not, and we will not be raising money for any operational things going forward. If we had to do M&A and we didn't have the money in the bank, then we would look at it, but we are not in the market for raising more funds.
Do you want to take it? Yeah. Does the new revenue model mean reported revenue growth will be materially lower in FY26 before recovering in 27? It's a big
Me and Fraser have been fighting about this for weeks. So we're in a very difficult position where, looking out the next 12 months, it is difficult for us to forecast, never mind Canaccord or Progressive or whoever, because there's a seismic change in our commercial model, right? For the right reasons, right? It means we make more money over the long term. It means we make more money quicker. So we've really struggled with how do we forecast accurately. It's hard enough, right? You crystal ball gazing 12 or 24 months in advance is very difficult, right? And I know, we thought, could we have, a more material range? We expect to go back to normal in 2027 in terms of, MRC growth. we've always been a monthly recurring revenue company, right? That's much more valuable rather than one-off stuff. So as we get back to MRC, as we've got experience in what happens with these revenue shares and the reality, then we'll be able to forecast. But we fully expect that, back, when we get into 2027, we'll be back into the normality of where we've always been in terms of percentage growth on ACMR. It obviously becomes harder as we get bigger to maintain the percentages, right? But this new revenue share model should take a year to wash out, and then we become more profitable. For Kraken Exchange, 30 million users. Based on your financial modelling, how long do you envision it take to cover your costs? That's a good question, Andrew. Don't have a clue. Like 13 million users, but you've got to understand, and I don't know, I'm guessing here, but probably 12.5 million of them are trading crypto on their phones, right? And where we come in is, market making, buy side, sell side, algorithmic trading. A mum sitting at home buying 0.01 of a Bitcoin on a phone is not interested in our services, right? So, Kraken's Exchange Cloud. Kraken is an exchange, as we put in the RNS. They have licensed Exchange Cloud, so it's an Exchange Cloud deal.
To achieve full year expectations requires significant growth in H2 versus H1. What makes you comfortable about achieving this? So, two things. So we're always second half weighted. Recurring revenue means you always deliver more in the second half than you do in the first half. We see what the first half number is and what the second half number is. Things like the Mexican exchange that we signed, that's due, that we're planning to deliver into H2. Again, that's on the old model, so you have the upfront element, and then there's other proximity clouds in the pipeline to be delivered in the second half. So we obviously have to be comfortable with what's out there in terms of forecast, and we have that pipeline to support it in the second half. But we've still got to deliver it, so it's it's going to be a challenge. But we get the gap.
Did Gordon say Mexico's largest exchange cloud client larger than Nasdaq? Some more detail we get. Mexico is the largest initial exchange cloud order we've ever had. Significant order, right? So again, I try and be as open as honest as possible, but there is some commercial confidentiality we need to retain, right? Mexico is the biggest initial order received for exchange cloud.
Assuming we can expect a temporary dips in metrics such as gross margin due to the revenue sharing model, maybe short term, depending again on how quickly racks fill up. However, year one, year 2, year 3, year 4, year 5, that's where we expect higher gross margins, right? So whilst there may be timing and there might be, a small transitional impact, ultimately we believe it's a better margin overall at a gross margin level. So, wouldn't expect it to be a significant drop other than a bit of timing.
What is to stop a major fintech services provider such as Pico or even Amazon? I don't think you can put Pico in the same sentence as Amazon or Microsoft. Nothing.
So this is asking about competing.
There's nothing to stop anyone trying to compete with us. There's nothing to stop me trying to compete with Starlink, right? But it's track record of delivery, right? You've got to understand there is billions and trillions of dollars going through the platform when we put Exchange Cloud in and it becomes mature. We've now got a track record of delivery. People know it works. People know it's scalable. People know it's secure. So I'm sure our competitors out there trying to build stuff. I'm sure they are, because they don't innovate, right? They just copy. But that's what having the use cases of track record delivery is everything. And Amazon and Microsoft, we are kind of lucky because while it's a big opportunity for us, it's too small for them. We're kind of shaded from the hyperscalers. They would have to re-engineer entire platforms to go and do multicast and proper time stamping and all that stuff. And the opportunity is just not big enough for them to do that.
That's been answered.
It seems I'm going to take this. It seems the majority of profits are absorbed by share-based payments. What prospects are there for shareholder benefits, given that we've just seen the share price fall by a third? I mean, you know, we have been honest about this for day one. Share-based payments are used to reward drive behaviour of staff. This is not a CEO reward scheme, right? What benefits are there for shareholders going forward? Consider the share price has fallen by a third. The share price is also up 500%, Richard. So I'll leave you that. Since IPO, can you give a reminder of how defensible your competitive position is, other than being first mover? I think I've done that. Track record of delivery is everything in our world. Where a customer has a very large customer base, such as Kraken, can you deliver on the first day the ability to service all of the customer base? Nope, I can't give 13 million users a platform, but I'm not saying that's what we do. What is the contract period reference in the GSE slide?
I mean, typically it's a 4-year contract for GSE.
Because it's the only platform out there that does. Why did Kraken choose BEEKS? Because it's the only platform out there that does cloud-based co-location on a multi-home platform. I'm not going to talk. Sorry, Julian's wanting me to talk about competitors. Who's our main competitors and what differentiates? I don't talk about competitors. Apologies. Sorry. What add-on products do exchanges want that BEEKS can address? Sorry, this is add-on products.
I think there's lots of questions that keep coming in, so we keep skipping.
Once you have that trusted supplier status of these big exchanges, how do you build out from there? I mean, and does the rev share put more emphasis on the BEEKS to ramp, explain, sell the product to end customers? We don't really have add-on services, land and expand, and getting multiple cabinets in the data center. We will maybe make some M&A acquisitions to bolster out extra add-on services, but no. Does the revenue share model put more emphasis on BEEKS to explain the product to end customers? We are the pre-sales arm of the exchange. We do not expect, whether it's month 1 or month 60 of the contract, the exchange to do the pre-sales architecture and sizing on infrastructure. That's what we do. So the new model has no change on that whatsoever. We're effectively, the exchange identify the customer, we have a joint collaboration, sizing an infrastructure, right sizing it for the customer, and then that gets deployed. So it doesn't matter what the commercial model is.
I think the question is, what time frame do the GSE numbers relate to? So when we talk about that slide, it's total contract value, and it's typically over 4 years. And are we expecting to retain them for the next 15 to 20?
Yeah. So what you got? So again, like once at the end of the contract, the exchange has got 30% of their trading volumes coming from our platform. What do? Do they say, you're on your own again, Mr. Customer, I'm not providing a service again that we're making money that your life's easy for? So I'm being a bit facetious, right? But it would be very strange for the exchange to just say after 4 or 5 years we're throwing this out, and customers, you need to stop trading and go and deploy your own infrastructure again.
I think next one, there's a question I think on the revenue note that rest of the world revenue drops period to period. That the reason for that is you've got last year with an upfront element of GSE, whereas this period there's the recurring element only. So when looking at revenue, we tend to do it from a product point of view rather than a location. We have to disclose location for statutory reasons, but actually, if a customer is based in US and taking infrastructure in London, where would you want to see it? But we tend to look at revenue from a product as opposed to a geographic location.
The 30-day rolling contract period for revenue sharing, does this speak to your confidence that customers won't leave? There's more that they will fill them, right? Customers have changing infrastructure requirements. Like we have customers that go out of the markets, that go bust, that get acquired. If you do a 30-day contract with an exchange and one of their end users goes out the market, then we refresh the hardware and the next client gets it, right? So no, the 30-day period is more. We are now confident that with the right marketing, this will fill. So that's it. That's why we're confident. It's not about customers not leaving. Why would you not offer certain exchanges in your revenue share model? Scale. If we don't think they can scale to where we actually make money, then we wouldn't offer it. Or if there needs to be a marketing plan behind it, right? How much competition is in an exchange cloud space? If none, how long do you think before it appears? Do you think? Don't know. I can't. Again, I don't have a crystal ball. I don't know what our competitors are doing. I mean, they are, a few of them have copied us before and the kind of low-level stuff. I'm sure a few of them are trying to copy us again, but whatever. Like we've got track record of delivering. It took us years to find a client who would take a risk on our platform, a calculated risk. So, yeah, yeah. Do I worry about our competitors? I worry about hyperscalers, right? Because they're obviously huge, but I just think that the opportunity is small for us. Our old school MSP competitors are all drowning under mountains of private equity debt, so they're not exactly innovative. That's us, I think, folks. So, timing was good as well. A lot of questions.
Perfect. Gordon, Fraser, thank you very much for answering all those questions from investors. Of course, the company can review the questions submitted today, and we will publish a response out on the Investor Meet Company platform. Just before redirecting investors, provide you with their feedback, which is particularly important to you both. Gordon, could I just ask you for a few closing comments?
Yeah, sure. It's been an interesting week, folks, and I know a few of you that have followed us for a while. Nothing grows in a straight line, right? So the company's in a better position than we've ever been in. We have a stronger team, stronger pipeline, more commercial models to lever deals, and we'll continue to do that. We have an exciting couple of years ahead. Ultimately, everyone knows we will sell the business, and we are moving towards getting to valuations and revenue and profit levels where the values become, where we're looking at. So, we're in a good place, we're excited for the next couple of years ahead.
Gordon, Fraser, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will then take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of BEEKS Financial Cloud Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.